Hello, how are you doing?
Hey, hi Justin, how you doing? I'm good.
That's good.
Did you have a good holiday?
It's pretty mellow. I didn't really do anything, just kind of hung out around the house and hung out with my kids, and we got a cat. So,
Oh, okay. Well, that sounds like fun.
I have a zoo now. I have two dogs, a lizard, a couple fish, a cat, and 21 chickens. So,
Oh, okay, yeah, you're right. You got a zoo going. You got a real
mhm.
menagerie. Well, yeah. I mean, whenever you got a couple of kids, you're bound to start acquiring pets.
Yep,
The whole bit. You got to keep them entertained. But
yep.
yeah, no, it's also good though. I think good for them when as they grow and get a little bit older, they can take a little more responsibility for the pet care and you get them involved in all that kind of thing. It just is a good thing. But
Here's the
yeah,
cat.
I remember, when I was a kid, I we always had a ton of pets. I mean, guinea pigs, hamsters, cats, dogs, yeah, fish,
Yep.
everything you can think of. So yeah, we kept ourselves pretty busy. But yeah, it sounds like some fun. Hi Joel, how are you?
Hi, I'm good. How are you?
I am well, thank you very much. Yeah, it seems like a while since I've
Really,
seen
look at
anybody.
my new friend.
Oh, hey, look at that. Hey, look at that cat. Okay.
My kids talked me into it, so.
Okay. That's great. I love it. Okay, well, we're just about at 3:30. We've got a few folks here, so let's just kind of start. We're gonna go through the homework assignment again. Same kind of format. I'll walk everyone through the true false and the multiple choice, and I'll call on a few of you guys to talk about some of the short answers. I like that approach. So let's get started here. The first question on the week 8 assignment was um, an active secondary market makes money market securities relatively inflexible instruments. Well, I think the statement from the text was that it makes market securities flexible instruments. So I just changed that around a little bit and made that a false statement. Um, I think almost everybody got that one right. There might have been a couple of exceptions, but just about all of you nailed that one. So good work there. Number two, this one's right out of the text, as I recall. Investment advisors often hold some funds in the money market so that they will be able to act quickly to take advantage of investment opportunities they might identify. Yeah, definitely true. Um, again, right out of the text, and it makes sense that you know investment advisors would hold some funds in the money market so that they can, as they identify investment opportunities, they can jump on them real quick and not have to divest themselves of some other investment to do that. So that was true. Number three, this is another discussion out of the bond history. Um, at one time, bonds were sold with attached coupons. I remember my folks when I was a kid had a couple of bonds that had the coupons attached to them. So this one kind of brought back some fun memories for me looking at those old bonds. But yeah, a lot of the older bonds back in the day used to have the coupons attached to them. Um, and then the investors would clip them off and send them in, or clip them off as they became um, dated and paid by the bond issuer. Okay, number four. This was a little tricky. I saw this statement and I was considering throwing out the question, but let's just talk about it. Number four, the equipment trust certificates are bonds used by issuing companies to finance property, such as heavy equipment and planes. Well, they're not used by the issuing companies, right? They're used by the companies that are acquiring the assets. So, it's a false statement, but a lot of you got tripped up on that one. So I'm thinking about it. If anyone who missed this question, everybody's who's here, let me take a look. Let me take a look.
I missed that one.
Yeah, Justin, I hate to point at people when they make errors. The same with you, Brazil. I noticed you just joined us. Welcome. Um, let's see who else. Who else?
I think I got that wrong too.
Yeah, Fabian, you did. Number four. Um, Lisa missed it. Ben missed it. Yeah, a lot of you did miss it. So I'm gonna relook at that and I might do the same where that I have in the last couple of assignments where Fabian has pointed out some poorly worded questions that might be contentious. Um, and then I'll see. No guarantees. I want to find the exact statement in the text and see how it was worded and if it's real clear. But yeah, a lot of you did miss it. It was it was definitely kind of a trick question with that, equipment trust, and then saying that it was used by issuing companies to finance equipment. You would think that the logical answer to that would be true. So I apologize for that one. So we'll see. No guarantees. We'll see what I come up with, and I'll let you know in a day or two. Okay, number five, in 2000, Congress passed the Commodity Futures Modernization Act. That's false. It's based on a statement right out of the text, but it wasn't the Commodity Futures Modernization Act. It was a different act, as I recall. Can't recall which one it was, but yeah, I don't think anybody missed this. Well, nope, sorry, Justin, you missed that one. Brazil, you missed that one. So, you know, sorry for that, but that's just kind of the way it goes. You got to go back and look at those. The community, I'm sorry, the Commodity Futures Modernization Act. Do a little word search on that within the two chapters that we're covering here, and you can read about that, and you'll see that that is a false statement. So let's continue on. Number six, stocks typically sell in public markets where bid and ask prices are readily available and transparent. Yeah, that's right out of the text. That's a true statement. Seven, the government does not actually pay interest on treasury bills. Instead, they are issued at a discount from par. Um, yeah, that's right. They don't pay coupons or they're zero coupons, um, zero coupon bills. Similar to corporate zero coupon bonds. Okay, treasury bills do not pay interest, but obviously since the investment or the future value, the par value is going to be paid. The face value is going to be paid at some point in the future. Um, their present values are obviously going to be less, right? Less than the par value because they're going to be received in the future, right? It's just a simple question of present and future value applying to these T bills. So they're all going to be selling at discounts, right? None of them are going to be sold for premiums. They're all going to be worth less than their par values or their face values because, once again, the the payments of the maturity value are at some point in the future. So that would make logical sense. Let's go to number eight. Treasury bills are useful investments when wishing to add return value to a portfolio, though they are considered high risk. That is absolutely incorrect. Um, it's probably based on a statement in the text, but I'm not sure. Um, but I just jigged around both sides of the equation. I talked about high return. Well, treasury bills do not generate high returns. And I talked about a high risk, and they aren't considered high risk investments, rather low risk. So that statement is incorrect on both fronts. Okay. 9, Fed funds are usually overnight investments. That's true. That's right out of the text as well. Fed funds are typically 1 day investments um, made by the Fed to member banks. 10, a bank acceptance is in order to pay a specified amount of money to the bearer on a given date. That is exactly the definition of what a banker's acceptance is. So that's a true statement. Okay, so we got all these out of the way. Let's take a look at some of these short answers. 11. Fabian, you did a nice job on this one. Why don't you tell us about who participates in the money markets and why they might do so?
Had to unmute myself, sorry. Right, so there are several participants in the money market. So we have, for example, the US Treasury Department, and they sell US Treasury securities to fund the national debt. Then we also have the Federal Reserve System, and they buy and sell these US Treasury securities to control M2, so the money supply. And then commercial banks, they also participate in the money markets. They buy the US Treasury securities, but they also sell certificates of deposit, and they also make short-term loans. And they offer individual investors accounts that invest in money market securities. They are restricted from owning stocks or corporate bonds because that's just the law, I guess. And so they buy like treasury securities, which offer them a good way to increase their bottom line with a relatively low risk profile and a high liquidity. Yeah, and they trade on behalf of their customers. Then we have private businesses who also participate in the money markets. So they buy and sell various like short-term securities as a regular part of their cash management. And then businesses that participate in the money markets are, for example, like investment companies, finance companies, insurance companies, or pension funds. And investment companies or brokerage firms, they trade on behalf of commercial accounts. And their primary function is to create a market for money market securities by maintaining an inventory from which to buy or to sell. And then finance companies raise funds in the money market by selling commercial paper. And they do that so that they can lend the funds to consumers for the purchase of durable goods. Then we have insurance companies who use the money market to maintain liquid, just because there's such a high liquidity in the money market, while they earn an interest on their investment, and thus they can increase their bottom line. And then pension funds also, they try to make a return on their investment. That's why they use the money market to increase their bottom line as well. Then we also have individuals, and they use the money market by purchasing mutual funds to use investment opportunities or gain a return on their investment. They also might buy like individual stocks with the same goal. And then another participant in the money market are the mutual funds. And money market mutual funds allow small investors to participate in the money market by aggregating their funds to invest in larger denomination money market securities. And they as well do so to increase their bottom line and earn a profit.
Yeah, I thank you, Fabian. I liked your answer. It's pretty comprehensive, as I recalled. And the reason I chose you for this one was because you did a real good job of really discussing all the different parties that do take part in the money market And you also gave good reasons as to why they do. So thank you very much for that. That was an excellent response. Okay, number 12. What is a treasury bill auction and what is its purpose? Justin, you had a pretty good answer to this one. What did you have to say about the treasury bill auctions?
I just said it. Treasury bill action is a process conducted by the Treasury Department to sell newly issued T-bills, as they're called, to investors. The purpose of a T-bill auction is to raise funds for the government to finance its short-term borrowing needs and manage its cash flow.
Yeah, I mean, in a nutshell, exactly right. I thought that was well said. Nice, concise answer without a lot of fluff. I mean, you got right to the heart of the matter. So good, excellent, very good. So anyone who wrote something similar to that got that question correct. Okay, number 13. What are repurchase agreements or repos, as they're often referred to, and how are they used? Jewel, do you want to tell us what you had to say about this one?
Yeah, sure. In a repurchase agreement, a firm can sell treasury securities and agrees to buy back the securities at a specified date in the future. Most repos have a short term, usually ranging from 3 to 14 days. Repos are commonly used as a short-term collateralized loan by government security dealers. Securities dealers use the repos to manage their liquidity and to take advantage of anticipated changes in interest rates. The Fed uses repos in conducting monetary policy. The maturities on Fed repos never exceed 15 days.
Yeah, very good. I thought that was another, nice, concise answer. I like the fact that you mentioned liquidity because that is really a key component of the repos and one of the primary reasons why they are used to finance short-term investments and financing. So very good. Okay, number 14, briefly describe euro dollars and how they are used. Hey, Dylan, you want to talk about number 14 a little bit?
Yeah, sure. Let's see. Okay, so I said a euro dollar refers to the US dollars held outside of the United States, often in European banks or financial institutions. The purpose of a euro dollar is to facilitate international trade, allow for global liquidity, and to promote foreign exchange market transactions. These uses may slow down in the coming years, though, due to more countries shifting away from the US dollar in current years. It's kind of been there's been a couple like big trades. I know like between Brazil and China this last year, there was a big one. So it could start slowing down.
Yeah, that's an interesting point. I like that final comment. Definitely appropriate for the way things have been trending, at least over the last several years. But yeah, I mean, the key to your answer and the reason you got the credit for it was that, euro dollars are essentially, offshore holdings of U.S. dollars, and they're used to help finance and facilitate global liquidity. So, yeah, those are the key elements of the answer, and very good. Thanks a lot for your response there. Okay, here's a nice general question. Briefly discuss the purpose of the capital market. Um, Karen, can you talk about your answer to this one? You with us, Karen? Okay.
I think she's here, but I don't think she has a mic.
Oh, okay. All right, Nina, you're up. What do you think about
Okay.
number 15?
So I wrote capital markets are usually used for long-term investments as the change in interest rates is not as heavy compared to the change in interest rates in the money market. Firms choose the capital market to protect against the rise of interest rates before the debt is paid off. This reduces the risk of the investment, although long-term interest rates are normally higher than short-term interest rates.
Yeah, good. I like that answer because you kind of factored in a little bit of uh, the idea of the yield curve, which is that whole idea that as term increases, then long-term rates will also increase. So you have a sloping upward of a yield curve going from a, you know, it's 0 point, which is low term, low interest rate, and growing is the term, which it would be on the x-axis, um, extends outward, and then your return on longer term investments is going to increase. So that is really part of the entire purpose of the capital market, and what investors do get out of the capital market when they choose to enter it. So thank you very much for that one. It's a good response. Let's go to the last few multiple choice questions here, and we'll wind up the meeting then. We got 16. According to the text. Now, whenever I say that, that means that this statement might be possibly be a general type of statement, but the statement is made specifically in the chapter or chapters that this homework assignment is covering. So this is going to be right out of one of the chapters, and they talk about the nature of difficult decisions for a firm. And while some of these obviously might be difficult decisions for any firm when conducting business, like specifying or diversifying product lines or reduce prices to gain market share, things like that are obviously difficult and important decisions. The statement I was looking for is C, whether a company should finance its growth with debt or equity. That's relevant to the material in the chapter, and that statement does come right out of the text. So C is the answer there. I'm sorry if any of you got that one wrong and might have been thinking one of the other answers was a better one, but I didn't make it all of the above, or A and B, or B and C only, or whatever. I did try to make the other answers incorrect enough that C would stand out as the correct option. So C is the answer there. 17. This is another one right out of the text, where they discuss the U.S. Treasury and why they issue notes and bonds, and that is to finance the national debt. Okay. Not much more to say on that one. It is obviously a true statement, and it's right out of the text when we discussed the reasons for the Treasury issuing notes and bonds. Okay, this one, a lot of you jumped on me for this one. Since 1974, interest rates on 10-year bonds have done what? And I think the statement is right out of the text. I mean, I take almost all these right out of the text. But Fabian contacted me and said, hey, and he even showed me a nice image of the graph, again, right out of the text, that shows, several periods of time since 1974 when the 10-year bond rate has been both above and below inflation rates. So the correct answer has got to be A, okay, that has fluctuated above and below, even though it's spent most of the time since 1974, the 10-year bond rates have been, more often than not above inflation rates. But, the word consistently there is kind of the determining factor, and probably why the text did make the statement. I mean, it's been consistently above, okay, inflation rates, the 10-year bond rate. But, the question is, what does consistently really mean? Okay. It's a poorly worded statement, and I went back and I gave everybody credit that had answered A instead of B there. Okay. even though B was the original, correct answer, you can see on my little cheat sheet here, I've got my little note that says I will also accept answer A. So thanks to Fabian, several of you got another quarter of a point. Okay, 19, liquidity of a security refers to what? I try to think of things that, could happen potentially quickly. The security being retired, it being discounted, um, but it's obvious that it's liquidity refers to converting things into cash, and how quickly. The higher the liquidity, the more quickly an investment can be converted into cash, just like any other asset. I mean, inventories on a company's balance sheet, they're not as liquid as maybe short-term notes or money market accounts or things like that can be sold very quickly. Inventory, you have to find a buyer for the inventory and eventually sell it, and you might not get the entire value that the inventory is listed on a balance sheet as having. So yeah, things like that. That's another reason why inventory might not be included in a quick ratio or an asset test ratio when it comes to the liquidity ratios of a company. Okay, it's the same concept, but here we're talking about investments, and in this case, the liquidity of a security, and that refers to how quickly it can be converted. So that's the answer to 19 and 20. We were just talking about the ongoing relationship between bond values and interest rates. As interest rates rise, bond values and fixed asset securities um, are going to fall. Okay, the value of bonds would fall, the value of money market securities would fall as interest rates rise, and once again, that's all a matter of present value. Bonds values are definitely going to fall as interest rates rise and discount rates that you're applying to those future cash flows on the bond, uh, as they rise, they're obviously then going to generate a lower present value of that asset, of that bond. So yeah, number 20 is interest rates rise, the value of bonds and money market securities will fall. And that's it. I'm happy to say that everybody did very well, despite a few of you missing a couple problems. It's, almost everybody had a 90% or above, so that's great. I'm glad to see this. Um, please continue your strong efforts, and I can't think of much else to offer here today. How's everything going in readings? Your upcoming assignments, everything seem to be making sense, everything fitting well. Oh, I just read Karen's message. Yeah, I'm here, but I don't have a mic. Okay, you're forgiven. Nina took the ball on that answer. Okay, but I don't see anyone raising their hands or talking about any issues. I hope everyone's doing well. The next week is going to be our last week already. It's hard to believe we're already here in week 9. So yeah, this week you're going to have the shorter week 9 assignment, right, and the final exam coming up. As you come across those questions as you get into your work, don't hesitate to shoot me an email with any questions you might have. But I want to make sure everybody's, completely clear on any questions or any assignment work that you've got coming up. So
Is the Is the final gonna be the same as the midterm where we get questions and just have to respond?
No, it's going to be very similar to the midterm, Justin. I've already constructed it. What I'll do though is I will publish something similar to what I did for the midterm, which is kind of summary of study topics that you should probably review. Um, you know, interest versus return, uh, money market funds, da 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 da. As I go through the different questions that I've already written, I'll pick out the key topic out of those and say, make sure you review these and so that you're comfortable with the entire concept of that subject matter, that topic. So you'll hopefully do well on the questions. But yeah, it's going to be, what was the midterm? Was it 50? I want to say I think it was 50 questions, which will be a mix, once again, between, just like our assignments, going to be a mix between the true, false, multiple choice, and short answers. Okay. But yeah, that should be about it, guys. So there's no questions, no other questions. I'll let everybody go, and we'll see you all on Monday for our last session. Okay. All right, everybody, have a
Awesome.
great weekend. We'll see you Monday.
All right, thank
Thank
you.
you. You too.
Thank you,
Bye.
guys. Bye-bye.